Good evening to all the participants. On behalf of Hyderabad Chartered Accountants Society, I extend a warm welcome to everyone present for today's virtual session on year-end financial closure, key precautions and common errors under Ind AS and AS. Year-end financial closure is a crucial process that requires careful attention to compliance, accuracy, and reporting standards. Today's session will help professionals understand important precautions and avoid common errors in financial statements. It is now my privilege to introduce our distinguished speaker, CA Vijay Totapally sir. He's a fellow chartered accountant with over 35 years of experience, including more than 17 years with global Big Four firms like PwC, EY, and Deloitte, and has held senior leadership roles at PwC India. He is widely recognized as an expert in Ind AS, IFRS, audit quality, and forensic investigations, and has handled assignments for listed companies, multinational corporations, and regulatory agencies, including the CID. He has also contributed significantly to the profession through ICAI committees such as the Ind AS Implementation Committee and Auditing and Assurance Standards Board, and has played a key role in developing professional guidance, including the audit quality maturity model. So we are honored to have you with us today. I now request you to kindly take over the session.
Thank you. Good evening, friends. It's real privilege for me to, address to this gathering after spending around 3 years. Am I audible?
Yes, sir.
Yes, sir.
We are
Yeah.
Good to go, sir.
Yeah. After spending 3 decades of uh, experience in practice, I have had some realized some truth with respect to the financial statements. My way of telling things is financial statements rarely fail because accounting standards are doesn't fail because the accounting standards are complex, but they fail because the basic discipline in year-end closure and disclosures are missing. See, this is what most of the regulators, I'll come to that in the later part of my presentation. They have raised all these issues. Today, I'll be touching down on the year-end closure, common errors in the financial statements. Of course, all these common errors have been compiled in the FRRB publications, also in the QRB publications. That could be a reference material for you to read out. But this session is not theoretical. It is based on some real cases. I can touch down some of the examples in terms of how we are looking at as an auditors and as a company professionals, and what could be the best way to do to avoid all these anomalies. Next slide, please. Yeah, so to start with, let us understand why this topic is suddenly so important. It is important because the environment which is around the financial statements have been changed significantly. In the sense, financial statements do not no longer read only by the auditors and stakeholders, because these are being read by regulators like NEFRA, FRRB, and lenders, private equity investors where their interests are involved, analysts, and sometimes even the social media researchers. They are been looking at these financial statements. And you all know the regulatory scrutiny has been increased significantly. NEFRA actions are raising. FRRB, fortunately, I'm part of that review group where the observations are becoming sharper, which we have noted for the past 2 to 3 years. And, FRRB, as I said earlier, they have come up with all kinds of errors, what is being noticed in the financial statements, which they pick up either sumo motu or uh, through other means where they have got notices to review those financial statements. And disclosure failures are now treated as very seriously. Earlier, it was not so, but now, any sort of missing disclosures, all these regulators are looking at very seriously. And today, documentation is no longer a routine or complete compliance exercise. It is being looked under microscope. Every entry, every approval, every email and working paper are questioned, A by the auditor, B by the regulator, C by the investigator, and even the courts. Because I have been hearing from my lawyer friends that every second day the chartered accountant is summoned for an economic offense committed by the client, and he is being subjected to grilling. So, as we used to learn in SOX, not documented, not done, which is the mantra of the current day. Strong documentation is now the first line of defense for and strongest evidence of integrity. So, friends, we need to strengthen our documentation. So, year-end closure, if I have to say, it's no longer a routine accounting exercise. It has becoming a professional risk area. See, let us accept one reality. Earlier, when the accounts were signed and AGM is completed, we all we all moved peacefully, saying that okay, the year closing exercise is done and dusted. But however, in today, comfort doesn't exist. Financial statements can be reviewed even after several years, which we all know. The regulator can ask for working papers like NEFRA is asking all these days. Judgments, what we have made in the financial statements can be questioned. So, assumption that once signed matter is closed is no longer valid. Today, true and fair view is not presumed, it is tested. Next slide, please. So, let us first speak about FRRB, Financial Reporting Review Board. I'll just briefly explain the processes for your benefit. Uh, FRRB picks some of the financial statements su moto, and I mean, they have something called a technical reviewer. That means some of the practicing chartered accountant with some laid down credit criteria has been empaneled as a technical reviewers, and they will be given all these balance sheets or financial statements which they have picked up su moto, and they will review those ones and populate all those observations, and those observations again will be shared to a group of chartered accountants, which is called FRRB group. Those group of chartered accountant debate and analyze those observations and find if there are any additional gaps that are that are existent in those financial statements. They compile and send to the board then deliberate all the observations, and in case if there are very serious anomalies, they issue directions to the audit firm, and they may even write to MCA against the companies. So this is briefly about the process. Then if you look at the FRRB published on all the observations, there are few common errors which they have, common patterns which have been established. One is Schedule 3 non-compliance. Uh, a message to young people, young chartered accountant is kindly look at Schedule 3, because the financial statement which you sign in the final deliverable should be in the manner so required to be disclosed as per Schedule 3. So FRRB says there are inadequate disclosures with respect to Schedule 3 and with respect to accounting standards, and there are incorrect application of accounting standards, poor classification, that is an item should be current has been classified as non-current, incomplete notes to accounts. So these are all the broad observation buckets which FRRB has analyzed. Most interesting point is many observations are not about complex accounting policies, but they are about presentation and disclosure failures. So sometimes when it feels that the mistake happened not because of standards are difficult, but because the instructions which are given in Schedule 3 and other accounting standards were not being fully complied with. Next slide, please. Now let us come to NFRA, an authority which reviews yearly financial statements. Probably you can see even today some news item on NFRA saying that they have completed review of certain big four's financial statements or something like that. And if you look at their common orders, their orders, the common mistakes or themes which you can bucket it are: A, lack of professional skepticism, no impairment testing, which has been documented, which they because they review the audit files also. So over reliance of management representations, no expected credit loss working, poor documentation of audit work. Again, the emphasis is on the audit documentation, and one line with auditors failed to exercise is, as per NEFRA, is professional skepticism in terms of the financial statements which they are signing off. This is the sentence which is most dangerous for any auditor to read. Next slide, please. So let us sum up the common themes uh, on in the orders. Like, if you study these multiple regulatory orders, one pattern emerges, which is judgments were taken, not documented. Assumptions were made, but not supported. Disclosures were incomplete. Management explanations were accepted without challenging them. So it is not always that the regulators said, regulators are concluding it is a wrong accounting. It is our inability to demonstrate why a particular decision was taken when these financial statements are being signed off. Next slide, please. Let us compare past and present. Earlier, risk for wrong accounting was a qualification. Do you agree? Maybe some discussions will happen with the management and the matter used to get closed. Today, the consequences are different. NEFRA notice or peer review impact on all your decisions what you have taken after the discussion with management, and it could yield to reputation damage, which we have seen for in the case of some of the firms. Sometimes financial penalty, like NEFRA is imposing on all audit firms for the non-compliance which are there in their orders. So as to say that the financial statements today is not a routine signature. So it is a professional judgment and with long-term implications. Let us look at the root cause of these failures for some time. Next slide, please. Let's ask one simple question. Why do year-end closures fail? See, although we have something called internal control on financial reporting with reference to financial statements, and one of the processes is to validate period end closing process. I don't think many of the chartered accountants are aware of how that process works and whether it is being tested, whether there are RCM supporting that process, that is risk and control matrix, and whether it is being tested to conclude in the report, saying in the IFC, internal control on financial reporting report, stating that such period end processes are in place and operate effectively. See, not because of these process period end process is failing, because not because of you mean we don't know how accounting how to do accounting, but because of some practical pressures like rushing the closure timelines, aggressive accounting targets, so bonuses are fixed on sales targets, etc. This ignorance of disclosures, cut-off manipulation when it comes to sales and other related stuffs, documentation gap finally. So in many organizations, closure is treated as a deadline exercise, not a quality exercise. This is what happening. Okay, this year I close by let's say 15th of April. Next year we want to close it by 5th April. I mean, those companies, they are not really looking whether that kind of an aggressive closing date can ensure the quality of financial statements and can ensure all the risks which have to be taken has been mitigated all or not. Let us look at some, slightly sensitive but true. Let me say that in many companies, year-end closure becomes a negative negotiation zone. What I mean by that is, many instances where I have noted, it'll be a discussion, but it will be a negotiation between the CFO and the auditor, or it will be between the management and the auditor, or sometimes between the lender expectation and the reported numbers. I hope you agree with this. Discussion happen around provisions, revenue recognition, and classification to please all these stakeholders. And somewhere between compliance and convenience matters. That's where the professional risk begin. From the regulatory experience and practical reviews, certain areas are consistently emerge as high risk. The areas are: A, revenue recognition; B, receivable provisioning or expected credit loss when it comes to Ind AS. Of course, the another important thing is your related party transactions, contingent liabilities, going concern assessment. If these 5 areas are correct and properly documented, most year-end closure risks reduce significantly. Otherwise, even the perfectly tallied trial balance cannot save the situation. Right? Next slide, please. Okay, let us look at the revenue and cutoff, which is again an important area, which is more sensitive and most misused area, I can say. Almost every major reporting issue somewhere touches this revenue recognition. Let us take one example. A company has recorded substantial sales as on 31st March. Invoices have been raised on 31st March, but dispatch of goods have been happened in first week of April. What management generally, we take representation. So they said billing is done, so we recognize revenue. Then we as an auditor accept the explanation and consider the subsequent dispatch of goods as a proof. Let me ask a simple question. As per your accounting standards, is it okay that on 31st March has the control of goods passed to the customer in this scenario? The answer is no. So the revenue should not be recognized. If you look at Ind AS 115 or AS 9, what it says? It says revenue is recognized when control or the significant risks and rewards are transferred. That means it's not when the invoice is raised, the controls is not transferred, not when target needs are met, not when management is optimistic. So let me ask one quick question. How many of you have seen, March sales book and April dispatches happening? In some companies, March is not a month. It is like a festival of sales, booking sales. So cutoff testing, I think we all have forgotten. And it is not a routine audit procedure anymore. It is a regulatory survival procedure when it comes to compliance of accounting standards. So let us understand what are all the lessons we learned from this case study. First, control transfer is everything. Documentation of dispatch and delivery is critical. Second, March spike in revenue is always a red flag. Whenever the last week sales from disproportionate share, auditors must examine deeply. Third, management representation, which you obtain in this case, cannot replace your evidence what you have seen. If revenue recognition is wrong and material, the auditor has only two choices. He has to either adjust the revenue numbers or issue qualification. There is no third comfortable option for the auditors. I hope you guys agree with that. Next slide, please. Coming to another important area, very common and very sensitive, is your trade receivables. Let us look at an example where company has a receivable of around 200 crores. Okay. Out of that, 60 or crores more are outstanding for more than 2 years. But generally, I mean, it's just an example. Provision is created for 10 lakhs. The management reply is, sir, we are confident of recovering this amount. So, I mean, considering the current scenario of auditors, auditor will accept. We all will accept. Okay, management is confident, so we don't even do the subsequent period testing. We'll just accept. Okay, provision is okay. Now the problem starts. If this aspect is subjected to regulatory grilling, regulator will ask one simple question: where is your scientific method of calculating expected credit loss? Under Ind AS 109, expected credit loss is not optional. It is a structured estimate. And if you look at all the NFRA orders, this was being pointed out. It requires aging analysis. It requires to define the default probability assessment and requires historical recovery pattern and forward looking information. It cannot be based on optimism. So on the lighter side, we can we can say that expected credit loss is does not mean expected optimum loss. Right? A common sense is if the receivables are old, provision must be justified with evidence. Otherwise, the profits are overstated and balance sheet will be misleading. Let us be, honest on one thing. Uh, how many of you compute expected credit loss scientifically? I think most of us follow only ad hoc provision. Some follow as the percentage comparing to the previous year. Some simply do a round off. If since we are doing all these things, this particular aspect will be, a subject matter of regulatory grillings. So what I suggest is the auditor must insist on working when it comes to the ECL provision, and CFOs must maintain an ECL computation file in a scientific manner. Next slide, please. Another favorite balance sheet item I will say is the capital work in progress. Let us take an example of a company showing a CWIP of a large amount, let's say 10 crores or 15 crores, but project is progressing for 3 to 4 years. So what the auditor is required to do is he has to do an impairment testing, of course, which will be not done in the normal balance. So still showing as an asset. Okay, let's come to the regulator. After looking at these kind of number, the regulator will ask a simple question. If the project is not moving for years, is is it really an asset or an intention? If you look at Ind AS 36 and AS 28, which requires impairment testing when the indicators exist, that impairment indicators exist. I mean, in this case, stalled project is a clear indicator for impairment. If the recoverable amount of that particular project is lower than the carrying amount, that is whatever the 10 crores which we talked about, impairment must be recognized. See, on the lighter side, you know, In some balance sheets, CWIP means carried without intention to perform. Okay, let's look at the next thing is the related party loans, which is again contentious. The less we speak, the better it be, but it is a very serious matter highlighted by all the regulators, NFRA and FRR. Let us look at some real scenarios which we notice in previous slide only. Yeah. Large loans given to group companies. When these scenarios exist, in normal course, large loans to the group companies, they are all interest free. They'll not be, if the auditor is going to ask or your assistant will be there and say there is no clear repayment terms, no formal agreement. But those loans in the balance sheet, they have been disclosed as considered good and recoverable. No fair valuation exists in case of these loans. And when it comes to disclosures, there are hardly any such disclosures. See, during our review in the FRRB group, most of the cases we notice in Caro, we have been one of the clauses it should be reported where there are interest-free loans. Uh, the auditor has to make a report and say in terms of quantifying how much is such interest-free loans under 186.4, if I'm not mistaken, which is missing in most of the balance sheets. And coming back to the disclosures under Ind AS 24, all the disclosures relating to the related party must be complete, because I have seen the list of KMPs will be incomplete. List of holding and subsidiary and other group companies are also not mentioned. And under 109, interest-free loans require fair valuation, which is not done in most of the cases. So in this case, both measurement and disclosures are incomplete in most of the companies, where we as an auditors also fail to, address this particular issue. And I have seen, some of the cases where related party transactions documentation is more important than the relationship. I think most of you might have seen in the companies a lot of interest-free loans where it requires adequate disclosures which are not there. These interest-free loans have to be discounted, and I don't know how many of you have really done it. If not, at least now please look at this. Okay, we can say, on a lighter note, group companies operate in trust. There is no doubt about it. But we as an auditors, we operate on evidence, and regulators operate with suspicion. Next slide. Next slide, please. Okay. So when it comes to these related parties, what are all the red flags? Large outstanding balances, no repayment schedule, as I said earlier, no interest, round figures, frequent rollover of these balances, lack of board approval. And we don't, many cases, what I have noticed is we don't even review the board minutes properly, or the board minutes are prepared at our instance. If these things exist, both the CFO and the auditor must evaluate the recoverability and disclose carefully, because these are all subject to regulatory grilling. And I'm telling you more, if you look at most of the NFRA orders or the FRRB observations, related party disclosures are being highlighted, and they seems to be saying that they are very critical. Yeah, next slide, please. Okay, the next case is on contingent liability, which is most debated one. Okay, let us take one example of this contingent liability. Like, for instance, a company has received a significant GST demand just before the year end, and the matter this is under appeal, let us assume. And as usual, management is confident of winning that, and the promoter will, or the person charged with governance, whomsoever the auditor interacts, he'll come and say, don't disclose this because we are confident of winning this matter. Let us look at what is the regulatory view on this. Even if the probability of loss is low, I mean, even the management is confident of winning the appeal. If the exposure is material, like suppose if the GST demand, let us say if it is of a 4 crores or 10 crores of a balance sheet size of 200 crores, then it will be material, right? So it should be disclosed appropriately as per Ind AS 29 and also as per Ind AS 37. Under contingent liability, although the probability of outflow that is remote. Disclosure doesn't mean, I mean, what we need to educate the promoters or the client is, disclosure doesn't mean admission of defeat. It means transparency. And in our country, contingent liabilities are treated as family secrets. Everyone knows, but nobody writes it. So let us be very careful when it comes to the compliance of uh, the standards of AS 29 and India AS 37, wherever it is applicable, when it comes to the disclosure of these contingent liabilities. Okay, let's go to the next topic, a case, which is capital versus revenue. I'm just here, I just want to explain on one part. It can happen even in the, let us move to the P&L now. Um I mean, generally it will be vice versa, but I'm taking it in a positive manner. So I want to say, when the company has undertaken a huge repair of renovation of a plant, and large expenditure has been incurred, let us say 100 crores of expenditure is incurred on renovating a plant and machinery, and they see good profits, so they want to charge off the entire amount to the P&L. So what is the impact? The profit is significantly reduced and assets are understated. Future depreciation will be distorted. If we know as an auditor that this particular expenditure on the renovation of plant has enhanced the life of the asset as per their internal technical reviews and the other approval mechanisms that are in place, which we get if we get that information like that, the basic then this expenditure must be capitalized, and the basic principle of you know uh, are being capitalized if such additional repairs enhance the life of the asset, it should be capitalized, not charged to the revenue. Of course, we will notice the other way around. Some repair expenditure incurred because they may not have adequate profits, they start capitalizing it. That is also incorrect. So we need to be very careful in terms of analyzing this capital revenue kind of a stuff. Yeah, next case law, please. Next slide. Okay. Another important or another red flag, I would say, which we have been noticing is this provision accounting, provision manipulation, and this is becoming a tool for you know profit management tool. Large provisions will be created in an year in the earlier years, and actual utilization will be lower, and the balance will be reversed as provisions no longer required. And subsequent year, you will again do. There is no scientific procedure. They'll again do a provision in the year where there are good profits, and that way there is an artificial smoothing of profit happens. To conclude that these provisions should represent the best estimate of liability, it should not be a reserve for managing profits. In some cases, interest is not accrued on loans, especially when it comes to the related party loans or in certain loan funds. Company has borrowed funds, but there may be in unpaid interest due to liquidity issues. Then the management thinks, okay, I don't want to provide for the interest, and then there is a tedious implications. So this violates the principles of accrual concept. Expenses must be recognized when incurred, not when paid. While reviewing the financial statements, some indicators where suggest some profit management can happen, like sudden improvements of margins, large other income near the year end, provision reversals, expense reduction in March, capitalization of routine expenses, which I have said earlier. What auditor needs to do is each indicator individually must be explainable and documented in the files with evidences. The auditor is requires detailed investigation of these things and obtain proper evidence, not merely obtaining a management representation or management you know inquiry. I think in the beginning I said non-compliance of schedule 3 seems to be the order of the day for most of the financial statements. And if you look at the FRRB publications, it highlights a lot of schedule 3 non-compliances. If you want us to bucket such non-compliances, which I could say they are common misses, are trade receivable aging. We still follow schedule 6, like more than 6 months, less than 6 months, rather than what is been asked in the revised schedule 3 in terms of receivable aging. Then Another thing is with respect to the MSME disclosures. These days it is becoming I could see some notes saying that the management is in the process of identifying MSME receivables, or not, could not, in view of the large balance vendor list, the management could not identify or something. If such cases are exist, you should have qualified in the internal control on financial reporting, not just accepting a note in the notes to the financial statements. So uh, there are commitments which are incorrectly disclosed, we have already said. And there are no, FRRB have noticed Benami property disclosures were not being made. Common errors were being noticed in the related party disclosures. Even when the transactions are recorded, disclosures are often incomplete. Like I said earlier, the list of key managerial personnel, the complete list of key managerial personnel sometimes will not be complete. Balances with group entities are not shown separately. Terms and conditions of the loans are not being disclosed properly. See, you should understand that related party disclosure is about the transparency. Users must understand the relationship and its impact. So we should be very careful in terms of such disclosures. One of the most critical judgment areas today is going concern. In most of the companies where they incur continuous losses in for multiple years and negative net worth, and there are defaults in loans, still prepare the accounts on a going concern basis without adequate disclosures. Going concern cannot be based on the hope what management gives. It must be based on the evidence that is required to be disclosed. Cash flow projections, funding support, and restructurable plans. If there is a material uncertainty that is exist which we are aware of, it must be disclosed. See, in most of the cases where there is an issue on going concern assumption, it should not be based on faith or optimism and blessings. See, when it comes to the regulator, their mindset is when they review the financial statements and the audit files, they are not asking complex questions. They are asking a simple but a powerful question: where is the evidence? What is the working? Where is the documentation? Who challenged the management? And how judgments are reached? If these questions can be answered clearly, most of our professional risk reduce significantly. So, in today's environment, documentation is your strongest defense. I would say knowledge is important, experience is important, but documentation is your protection. If the judgment is challenged after 3 years, your memory will not protect you, but your files will protect. See, every major judgment should have a note or a memo which should be as follows. like, it should be like, what is the issue? What is the relevant standard for this specific issue? What's the management position on that issue? As an auditor, what is your evaluation? What is the evidence that you got? What is the evidence you didn't get? And based on all these parameters, what's your final conclusion? If you have this, in as practice, this note, this will save you in case of any professional difficulty. Please understand, if it is not document, regulator assumes that you have not done the work. Please document the areas of judgment. For instance, revenue recognition decisions, expected credit loss computation, impairment testing, going concern evaluation, contingent liability assessment, fair valuation assumptions. These are all the minimum things you should always document in your working paper files. Wherever there is an estimation or judgment, that must be documented with the basis on which why this particular judgment has been taken. I've explained you the format of how your judgment should be structured. Probably you can follow those things. Next slide, please. Over the years, I suggest you to follow a 5-layer module for safe year-end closures. I feel if these 5 layers are properly addressed, the financial statements what you sign will be far more defensible. Let us understand this framework. The first one is the balance level, layer one, what you can say. First layer is the balance sheet authenticity. Let's ask a simple question. Can every member, every number in the balance, can every number in the balance sheet be supported with evidence? For instance, let us look at trade receivables. Is it supported by the proper aging and the recovery? Are loans which have been disclosed or supported by agreements? And when it comes to investments, are they supported by valuation? And when it comes to CWIP, is it supported by the project status? If not, I have already said it will be subject to impairment testing. Please note, the balance sheet should represent reality, not the intention. Let's come to the second layer, profit and loss account and its correctness. Revenue should be recognized correctly in line with the significant accounting or rather material accounting policy, which is disclosed, which should be in line with AS9 or Ind AS 115. All the expenses should be fully accrued. Capital and revenue should be properly classified. The interest should be accounted on accrual basis. Provisions scientifically to be determined. Profit is a matter of opinion until regulator forms another opinion. The third layer of disclosures are today's failure, related party disclosures, contingent liabilities and commitments, MSME dues, going concern. See, I will say, the golden rule is if you have a doubt, please give disclosures. Non-disclosure always carries a higher risk than the disclosure. So these are all the basic balance sheet checklist item. uh, for your information. Let us look at the red flags. What I suggest when you are reviewing the financial statement, scan for all these red flags, like whether there are any old receivables, how old is your CWIP, whether it is more than 3 years or more than 5 years or what it is. Look at the month on month spike of your revenue sales, or especially concentrate on year end. If it is March sales, if there is any spike, large other income, which includes provisions no longer required and things like that. Low provisions, have a year on year comparison with the previous year provisions as well as the last year provisions. The no contingent liabilities again is a big red flag you need to assess. Large related party balances. And another important thing is the round of figures. If such multiple red flags exist, deeper review becomes essential for these financial statements. See, I will say one thing, if your financial statements look too clean, then it requires deeper cleaning. Next slide, please. My message to auditors, fellow CAs, please exercise professional skepticism. Challenge management politely and not uh, uh, aggressively, but firmly. Obtain, please obtain major evidences for major assumptions. Document all key decisions, whatever you have taken during your audit, and wherever required, issue a modification, modified report. Please note, qualification in a year may be uncomfortable in the short term, but it protects your credibility in the long run. I'll say that qualification hurts 1 year, regulatory action hurts the entire career. So please bear that in mind. Now let us, I hope there are few CFOs in this forum. So a message for them is, auditor is not an obstacle. Or please take auditor as your credible partner. Provide complete information. Avoid aggressive accounting. Give the supporting documentation what the auditor insists. Encourage transparent disclosure. See, I would say the strong CFO auditor relationship is built on professionalism, is not a matter of convenience. Please note, the CFO auditor relationship is not friendly, it is professionally respectful. Next slide. Let me now come across a very practical slide. Avoid these statements, please. First thing is, last year also is same. This is a most dangerous sentence in documentation. So if you are article assistants or your manager saying it's the same as last year, it's a very dangerous one. Just because something was done last year in terms of a specific treatment, every year it should stand say it should we have to do an independent review, because there could be a change in the regulations, there could be a change in the business, the risks also is changed. So instead of saying that we must document what is checked in this year, what was changed, why it is being changed. Another important aspect with respect to materiality adjust, what I can say, what does it mean? It means, like, I'll just give you an example. You have given some small work to an article with respect to uh, comparing the profit and turnover and the total expenditure. The auditor finds an electricity expenses of, let us say, 4 lakhs not recorded, and the company's profit is, let us say, 8 crores, right? So what normally your article assistant whomsoever comes back and says, sir, 4 lakhs is not material, so I am ignoring it. But you should ask a routine question in this. Is it a routine expenses every year? Is management intentionally postponing these expenses? Does it convert loss into profit? Is there any compliance impact? Of course, in this case, it may not be there, but these are all the standard questions you are supposed to ask your assistant. So one line of conclusion for this is, immaterial does not mean ignore. It means correct if possible, disclose if it need, document always. So what some of the larger firms do is, they will aggregate all these immaterial items which in the first instance they will ask them to adjust. If they are not adjusted, they will make a summary called summary of unadjusted differences. If the aggregate total of such unadjusted differences exist, they will insist the client to pass the entry if this aggregate summary is a material item. I don't think in this kind of approach is being adopted by small and medium firms. Correct me if I am wrong. If you are doing, it's good. Otherwise, I recommend, first correct the entry wherever you have differences. If not corrected, evaluate your materiality, document all those small errors which you have noticed in the entire financial statements. Check the cumulative impact, decide whether this needs to be a reportable aspect, or convince the client to pass the necessary entries in the books of account. That is about the materiality adjust means. The third one is, I mean, this is what I have noticed these days, saying, sir, our AGM date is already fixed. That means they are going with an aggressive timelines, not looking at their closing process effectiveness. That is financial statement closing process effectiveness. See, I think, I mean, we should note the account, note that the accounts must be correct first. AGM comes later. If you see that, there are anomalies in the financial statements, although there is an aggressive target dates, you need to have firmly talk to the client and tell them that the aggressive timelines may not be possible. Otherwise, we as an auditor may face regulatory grilling for signing an incorrect financial statements. Okay, another point which I come across from most of the CA friends is, sir, management has confirmed. Management confirmation, friends, are not the piece of evidence. Audit, as an auditors and professionals, we must verify independently with key evidences of that particular matter. If we only write management confirm, then it appears that no verification was done. If you look at some of the FRRB observations which they have given, which I mean, where in Caro, as informed by the management, they are putting it as a red flag and issuing directions to the auditor. That means they are concluding, FRRB is concluding that the auditor has not done any verification. He is just taking what management has said. So, what is the overall message for all of us? Casual documentation creates serious professional exposures. So, every word we write can be read by the regulators, investigators, or even the courts. So, let us move from casual noting to careful documentation, because what we write today will be examined later. Because these days, although the institute says the documentation retention period is 7 years as per SQC1, correct me if I'm wrong, but when the client was subjected to any regulatory grilling, the regulators insist for audit documentation. At that time, we'll be struggling to find out the right working paper or the right documentation evidence which we have gathered and concluded. Let's move to the next slide, please. What is changed in last few years, friends? Earlier, we used to, when we started our CA career, when I started rather, we were just focusing on number crunching. There was very little focus, now there is a huge focus on transparency. Earlier, we were just looking at compliance was enough. So if you comply with accounting standards, that's it. But now documentation is key. Earlier, whatever the opinion we have expressed, okay, we once we close the audit, we finish the AGM, we used to have a good sleep. Abha, we have finished this particular year, closed, happy kind of. But now our opinions have been examined, reviewed, revisited, and a lot of questions being asked, and all our judgments are subjected to regulatory ruling. Next slide, please. So let us look at what regulators are expecting from us. Today, whether it is a Companies Act, SEBI, NFRA, income tax, or any regulator, expectations are very clear and very high. First, true and fair. This is the foundation of financial reporting. Financial statements should not only technically correct, they must reflect the real picture of the company. That's what they are expecting. Although we say true and fair, they are not accepting that. Sometimes numbers may comply with accounting standards, but still, they feel that so most of the financial statements may not reflect the true situation. Regulators are expecting us to ensure the accounts what we have presented uh, true financial represents the true financial health of the company. As professionals, we must ask a simple question: does this really shows a correct picture? I mean, when I was been working with other firms, uh, whenever we used to go to the audit committee, there used to be this standard question: does this financial statement reflect the correct position? We used to answer yes. So that used to get documented as part of the audit committee minutes. I don't know whether the same questions are being asked nowadays or not, but this that was there when I was with some of the large accounting firms. So they had some kind of a discipline. So that's how we have learned in the hard way. Then second is the full disclosures. There is no choice when it comes to the disclosures with respect to the accounting standards, disclosures with respect to the Schedule 3, Division 1 and Division 2. And hiding information in notes or giving an incorrect, incomplete information will create a regulatory risk. Please note, transparency is the key word now. If something is significant, please disclose it. Disclose it properly, clearly, and use simple language. The third one is your evidence-based judgment. Your earlier days have gone where the decisions are taken based on the experience. No, for every decision, there should be a document to support why, what evidence that you have, and how this decision has been taken. The working paper should speak for itself when it comes to the evidence based judgment means. Then the accountability is key. This is the most important expectation in terms of the regulatory standpoint. Earlier, I think the responsibility was little general, but today the accountability is a specific and personal. Regulators are asking who approved, who verified, and who reviewed. Therefore, documentation and clarity of responsibility is very, very critical. To conclude, please note the regulators are not only checking compliance, they are checking the intent, transparency, and responsibility. Our role as financial professionals and auditors is to ensure that the financial reporting stands the test of scrutiny at any time or in future. We should ensure true and fair, but with full disclosures, evidence-based decisions, clear accountability. We will always be safe side professionally if we do this. I will ask you one quick question. Before you sign a financial statement, are you asking a question saying, can I defend this balance sheet confidently for 5 years or later before any regulator with full documentation? If answer is yes, please sign peacefully. No, resolve before signing. One of my partner, which I used to work earlier, he used to say, Vijay, take a deep breath before you sign the balance sheet. And he used to ask the same questions what I have said to you. Next slide, please. Next slide. Let me close this presentation with one final thought. Please note, financial statements are not just numbers. They represent the credibility of management and integrity of professionals who sign these numbers. Trial balance may tally automatically, but now because nowadays you have automated softwares where the numbers are going to come in. But true and fair view requires judgment supported by documentation. And some. Thank you very much. If you have any questions, please let me know. Thank you. And I can expect, going forward, uh, you please ensure and keep the ICA flag flying. Uh, so don't, accept the representation from the management and conclude your financial statements. Do proper documentation, justify what your conclusions are. Thank you.
So, thank you, sir, for the insightful session. Your practical insights, expert guidance, and simple explanation have provided great value to the participants and will certainly help professionals in ensuring accurate and compliant financial reporting. I also thank all the participants for joining us today. I will now be ending the session here. In case you have any doubts, you can post them directly in the group or you can post them directly to sir. Thank you.